Well, hello, everyone. Good afternoon. We'll give just about one more minute here. Everybody come on in. We've got a lot to cover today. It's the 21st of January. January is almost over already. All right, well, let's go ahead and get started. It's 2022, so I'm not going to say Happy New Year, everybody, because that's going to sound really strange on the 21st day of the first New Year. But I will say it this way. I hope everybody's New Year is going well so far. How about that? So we have we got some special guests today. And we have a panel that we're going to be doing later. Home Depot is going to be speaking for a little bit. And then, of course, we'll be getting some updates from Charles Tassell on what's going on in Washington, D.C. Before we do that, I'm going to turn it over to our Executive Director, Rebecca, to give you guys a few other announcements.
Thanks, Ryan, and welcome to everyone. Just really quickly, although we definitely will be talking about financial concepts today and places where you can invest your dollars. We are not financial advisors, don't pretend to be, nor are we attorneys, CPAs, or anything of the like. So if you have specific questions under those categories, please make sure that you consult with someone in your local area about your situation specifically. We're here, though, to promote, protect, and educate, and we've been doing so for almost 35 years now. We've got 120 plus local chapters, 40,000 plus members, and we are thankful that you're here, and hopefully you're a part of that. We're also sponsored by Home Depot Pro, who will be joining us at some point today to talk about the programs that we have together that are specific to our membership, including 20% off paint at the gold level immediately, a rebate program, other kinds of programs like cabinets and others. If you are interested in those exclusive programs for us, you can find on our website, which is nationalreia.org, the way to find a local REIA. So you just scroll right over, I'm an investor, find a local REIA, and you can see all throughout the United States where we have local groups that you can join. We'd love to have you, and can answer any questions that you have specifically about those programs or other things, either at the national office or through your local offices. So please feel free to reach out. We've got lots to cover today, so we're going to jump right into it. Charles, I'm going to turn it over to you for the legislative update.
Share this here real quick with everyone. So a couple of things. If I can get it to work. There we go. So yeah, as I said, I want to set the table, kind of going into 22, what we're really looking at. And this is where, from a, if my screen will work. All right. This is what isn't happening right now. We are not seeing the forest for the trees. Things are blocked up. So I'm going to go through a couple of things real quick. Here's what I mean by this. This is according to the White House as of, I think it was Wednesday, Thursday of this week. Notice that the last legislation passed right here, July 6th of 21. All of this was passed in the first 6 months. After that, nothing's been passed. So literally we are at a logjam. Now, I will suggest to you that is not necessarily the worst case scenario. That's not necessarily terrible. This is just kind of a perspective. It does take good laws, consistent laws that make it actually accessible for us to do our jobs in being entrepreneurs. It's the stability of the laws, not the stability of the economy, where we can really make money and build wealth. So with that in mind, these are a couple of things that have passed, and I really want to focus more on the regulation side of things that are coming, whether it's the student loans that have been kicked out to May now. Again, foreclosures, this is where the evictions are currently. We're seeing some extensions. New York finally said, hey, imagine that, we're actually going to stop the eviction moratorium. People actually need to pay their bill. We don't do this with mortgages. We don't do this with a variety of other things, but this is still where it's at. So this is currently where we're at. If you have updates, please send them to us, send them to me. I would greatly appreciate it. But I want to share with you something. Again, Ron was noted for this. great statement about a crisis. And, when you're a legislator, legislation is your hammer, everything looks like nails. So you figure out how to do it. Hopefully it's the right size hammer for the right size nail, not trying to use a sledgehammer on a screw, but they're legislators. They're going to be pounding on it. What I want to point out though is this, and this is a question that we asked our economists for this last article that came forward, and it was, what's the difference between red state, blue state? And I don't mean it in the sense of Checkpoint Charlie, but in the sense of lockdowns, the impact of them, the longer term, literally bifurcation of our country. So the red states there are completely red. They're House, Senate, and governor. The blue states are same with Democrats. So what are we seeing economically as a difference? And it's something to really pay attention to. Those gray states, those are still split power. Split power is not a bad thing. You tend to get more balance out of things. So just understand that. Having said that, here's when you get down into details of it, what to really look for. And I bring this out because something we've been talking about is getting to the data side of things, getting in there and saying, how do we help people from either a legislative perspective or an economic perspective because of the fallout of the legislation? How do we help you? And this is something to bear in mind. People have been asking, how's the country doing? How are members doing? I'm like, well, where at? Because it is so different depending on where you're at. And that's something we're trying to get a handle on to be able to answer everybody's very, very different questions. As I mentioned, Checkpoint Charlie is somewhat, if you don't have your vax papers in some area and other areas, they would look at you like you've got three heads if you walked in and said, I got my vax papers. It's a very different world we're living in and very different areas. Now, one of the things I'll point out is this is the REIA value proposition. Okay. Grass always looks greener. We want to always go out someplace else. But the value is, I can tell you from buying property, 2 blocks one way, $100,000 valuation higher, 2 blocks the other way. You're kind of going to need a jacket. I mean, a bulletproof jacket, and better go in with some guards because it's dangerous. That 2 block difference and knowing that is really part of the value of REIA, in that there's folks who know the areas and really know not, this level of detail, but can actually get you down into the actual block by block areas and knowing neighborhoods. This is something that is absolutely a real value I want to make sure that we're bringing out from a membership perspective. So with that, we've talked about these issues, kind of the national themes, both the evicted book and the non sequiturs, and how it does not actually relate to reality, and how, whether it's the Princeton lab that is supposedly using the name Princeton and supposedly very academic, is not peer reviewed and is more propaganda than it is actual science. There's more of that coming out. The other piece is the housing is a right. Both of these have come together consistently. Folks, we're going to continue seeing that. And the undercutting behind the scenes is that access to background checks. Keep your ears open, not necessarily at the state level, but at the municipal level. Again, this goes back to that nice map I showed you where it's based on each different area. Those municipalities within those different areas are treating these things extremely differently. That also goes for source of income, which is whether or not you're required to take Section 8 housing choice vouchers, or if there are other requirements even to include in that source of income. So bear that in mind. This is one of the biggest concerns that we have. Dave and I've talked about this over at Rent Perfect, the whole security deposits, source of income, how the limits that they're putting on us so that you cannot limit your risk. That's the problem, because of the business perspective, I want to minimize my risk. That's how I protect the dollars, how I protect the valuation. I don't want to walk up to somebody walking down the street and say, hey, I've got a $100,000 valuation here on this piece of property. Go ahead, walk in. I wouldn't do that. But from a business perspective, that's kind of what we're being asked, is whoever walks in, you got to sign off on. And so being able to make those arguments is absolutely critical. So we're going to see more of that coming, especially in 22, much more focus on the municipal side, even beyond state and federal side. Now, having said that, let me share with you a couple of things on the federal side. These are a couple of the bills that are out there, from the infrastructure package passage to Build Back Better, most likely getting split up and coming in pieces is what we're hearing. Part of that being $150 billion for HUD, a variety of options. We may be hearing from HUD on what that is, and hopefully directly to National REIA on that. And I'll come back to that why and how in just a minute. Voting rights bill, which again, back to those trees, they're not seeing the forest. They're seeing a couple of trees and stopping everything in its tracks because of those trees. There's an eviction tracking bill. We've been watching that. We've worked behind the scenes on it. For a variety of reasons, we are not in favor of the bill, but we are not opposed to it either. So bear that in mind. Section 8 reform, to me, this is pie in the sky. And I'll just tell you right now, the last bill that was Section 8 reform sat there for about 10, 12 years, and finally the regulation side of things caught up with what the reforms they wanted. Now, 10, 12 years of regulation later, you can see where we're at. This bill will sit for the next 8 to 10 years is most likely. It's not high on the radar. And what will happen is regulations in HUD will probably catch up to it at some point during sub-administration. Seller finance, also called the Affordable Home Ownership Access Bill, HR 5301, is out in House. We have a Democrat sponsor on this. We are adding in Democrats and Republicans. You can go to Voter Voice Now and encourage your representative to sign on to that bill, become a co-sponsor of it. We really want to get around 50 to 60 co-sponsors. So please go to that area, go to the Action Center, sign on. It's real easy to send it in. It'll be very important. The following one is affordable housing. This is YIMBYs. People are used to this. They're used to NIMBY, right? Not in my backyard. Some of you know bananas build absolutely nothing anywhere near anyone. IGMFUs is a description of people who have moved into an area, maybe own a 1 acre area, but all around them is all park. And their comment is, I got mine. I'll let you figure out the rest of that. They don't want anything else built because they came in and got their 1 little acre and now they feel like they live in a park, but it's not their land. So this contrast bill is a YIMBY bill, which is saying, yes, we need housing and people are realizing that we have a shortage of it, but it's an issue of how do I get housing built in my backyard and what does that really look like? So this is a bill that we'll keep an eye on. This is one of those bills that could be a lightning bill. In other words, it could catch lightning and take off, or it may sit and not go anywhere. So with that in mind, I want to mention a couple of things. These are regulations at the federal level. Moving quickly through these, but this is one, lead paint coming back, and it's coming back because of EPA. The new directors are finally in. You might remember even in August and September of last year, I said they were getting slow to get in. A lot of directors are in. These are appointee positions, not necessarily Senate confirmation, but appointee positions. So one of the key pieces they're coming up on is lead paint. We're looking at a variety of things from energy efficiency. There's now a climate change initiative director at HUD, first time ever. Expect energy benchmarking, among other things. So if you've already got experience on that issue, please share that with us privately. I do want to hear about that. If you're seeing energy efficiency or benchmarking programs at a municipal level, please share that, because those, I can tell you this, HUD is going to be aware of those. We're going to be sharing them as well. We want to make sure we've got good answers for them, both positive and negatives of what's going on. So just remember that if you're out there and you see energy benchmarking in buildings. Increased fair housing investigations, we're seeing that. Fannie, Freddie, Ginnie have come out and stated in December, they are not interested in increasing the wealth and availability of funding and capital for second homes for people who are buying second homes. All that, that's not their interest. And part of it, they said most people are just making money on that. They're actually, it's not really a second home. It's an Airbnb. It's something like that. So they want to focus on low income, first time home buyers. So that's going to tighten up the market for those second homes, or what's perceived as a second home. Additionally, those of us who've been around for 25, 30 years might also remember that low income first time home buyer focus is exactly what was started in about 98. It grew up through about 2008. So are we on track to replicate that again? We very well may be. There could be a little bit of difference because there's a little less housing availability, but that's where it's at. Affirmatively furthering fair housing is another one that we've got coming out. This is going to be revamped. It was considered to be changed and modified during the previous administration. This administration wants to put it on steroids, and that's what they're saying. They're looking at coming out with some new rules. We'll see what that is. And that's just not to mention IRS, CFPB, and a variety of others. We are working with them as best we can. And let me just tell you, it was just in the last week that HUD has started to say, yeah, we actually do want to work with you on from a stakeholder perspective, and we will be involved. Initially in March of last year, the White House had told the Housing Coalition, unless you're bringing us equity information, we don't want to talk with you. And that was a very odd conversation. So a very short one too. So things are warming up a little bit now, and we're hopefully going to be doing better with that. So as I mentioned, a couple things, voter voice, we do have some action out there. The moratoriums are draining off, but we do have the Action Center going on 5301. Please check that out. Also, Bill Track 50. If you want to find out what's going on, especially new legislation starting up, you can track this. You can find out what's going on in your own state, and it does track federal as well. But again, being able to track it in your own state and figure out what's going on is absolutely critical. To that end, we would love to do a day on the Hill in March. It does not look like DC is going to be open. It is not opening up, and a lot of the staff are still at home or working from home. And by that, a lot of times that means actually in district, not even in DC. So there's very limited ability, and even the security process to get into one of the House buildings or Senate buildings is very difficult right now. So what we're looking at is doing a virtual day on the Hill. There's going to be more details coming out on this, but it's on March 18th is what we're looking at, which is our normal day like this. But we're looking at, we may have some earlier time-frames for some earlier speakers, and then start off at 4 with the rest of it, so that everybody who's got this time frame plugged in can still continue to hear that. So we'll share more of that. So keep your ears open on that. The final one I want to mention is a little note here for me to mention to you is a survey. This has gone out already. Lori's going to post a link in the chat about the survey. Please go on and fill out the survey. This is important because it gives a pulse of where things are at. And the last question is an open-ended question, just to say, hey, please tell me what's going on. If you're seeing something, hearing something, we need to know it. And again, with the diversity of how the country is being handled from state to city to everything else, we need to really get a good feel of the pulse in the different areas. So we're asking based on states and zip codes versus, please tell us what you're seeing for based on where you have property and such. So please fill that out. I really would appreciate that. It helps us get better information back to both legislators as well as the media in helping draft a narrative. So with that, the final piece we want to mention is this. The Fed has already said they're going to raise interest rates at least 3 times. The Wall Street folks I'm talking to are saying anywhere from 5 to 7 times. Now, how many points those are going to be, it's anybody's guess at this point, but this is a question of how much impact are we going to see in the housing market. We've got supply and demand issues on both sides, from shortage of supply to high demand levels, but we've also got numbers and pricing starting to hit a peak in different amounts in different areas around the country, but they're hitting peaks. So are we seeing logistics issues that are slowing this down even more? And are they exacerbating it? Will those be resolved? Our economists are saying a lot of that should be resolved as we go through 22. But by the time we start hitting interest rate hikes, are we going to have a capital crunch? And folks, is it going to be difficult to then sell or get funds to do a business? So it might be time to start preserving some cash. And again, this is going to be different depending on where you're at in the country. So kind of like Sun Tzu says, fish in troubled water. The waters are going to be troubled, but make sure you know which trouble you're fishing in. I'll put it that way, because the businesses are there, and we want you guys to make wealth and build and grow, but we also want you to make sure you have as good a heads up as absolutely possible going forward. So with that, thank you very much, and I'll turn this back over.
Thanks, Charles. Appreciate that. I always learn something every time he's speaking on these updates, so we greatly appreciate that too, to keep us current with all this information. It's very important. I know, Rebecca, that we were going to have Home Depot come on for a few minutes, but I don't see, is Brian here?
He has requested that we postpone till next month because he thinks he has some goodies that he could announce not today. So he's asking, since he's not allowed to talk about it today, that we postpone for next month. Okay. So in that vein, by the way, next month we'll have the Home Depot update on some goodies they're adding to the program, as well as an industry update with John Burns, which kind of will echo a lot of what Charles is saying and what it looks like in the market. It's because of all of those issues that we're so excited to have the team that we have on today. Robert will not be joining us as he has an emergency that probably will not be resolved in time for him to hop on.
Okay.
But other than that, we're super excited to have this group. And Ron, I'll let you take it away to introduce them.
All right. Well, today we have David Gorenberg. He's the managing director of Accruit LLC. So welcome to David. And Jeff Seal, who's the director of originations at GroundFloor Finance. So welcome, Jeff. Welcome, David. I'm going to let you guys take it away from here.
I don't know who you want to go first, folks. So
You go for it, David. You're already
All
up.
you, man.
Come on in.
thank you. No, yes, I'm David Gorenberg. I'm a managing director of Accruit. Accruit is a national 1031 exchange qualified intermediary. Accruit has been in business for about 21 years. I'm a licensed attorney in New Jersey and Pennsylvania, but I have spent the last 21 years also as a full-time qualified intermediary, forward exchanges, reverse exchanges. If it's legal under the code and under the regulations, we do it. And regardless of where you or your business partners may be, anywhere around the country. And for those folks who may not be certain that they want to reinvest in another hard asset, we work with a lot of providers of Delaware statutory trusts. We work directly with the sponsors, but more importantly, we work with some really, really top-notch advisors on Delaware statutory trust. Advising on which is the right DST for any one person is not the province of a qualified intermediary, but we do know who some of the best of those advisors are. So I'm thrilled to be here. Last time I was here was about 6 or 7 months ago. Glad to be back.
Great. Thank you for that, Dave. Jeff.
Awesome. Thank you, guys. Yes, Jeff Seal, Director of Originations at GroundFloor. And so GroundFloor, if you were to go up to the CEO and say, you know what, that's a great origination platform, he might slug you in the face. I mean, that was never the premise. GroundFloor was created for specifically for the investor side of the platform, right? So the premise was to create a platform for non-accredited investors to invest in real estate, right? So it's as simple and as clean as could be without getting your hands dirty, a way to steward your own investments, specifically in real estate. And so now I oversee the origination side of things, but for that to be, for that to work and for us to have capital to do so, we of course rely on the crowd side of GroundFloor. So it is crowdfunding at its finest, right? And we've done it in a way that allows, like I said, non-accredited investors to participate in that. So anyone with $10 can log on to GroundFloor and can invest that in different tranches. You can do it very simply, right down the middle, right? If you, as far as mitigating risk, if you're not really concerned about that. You can do it right down the middle and earn 10%, and that's a proven earnings over the last 9 years. It's been around 10% on average, has been the return. But you can adjust that, right? Sometimes if you're not a risky person, and by risk we're talking about a change of 2 or 3% of a potential default, right? That'll swing down to maybe you get into the 8%, 6% tranches on your expected return, and then that can swing all the way up to 12. And there's not a huge variance there, but it just depends on what you're interested in. And you can also make decisions on area, experience of the borrower. You can invest $10 across a few hundred different properties at a time, right? You can be as diversified as you'd like. And so that's what our platform does, and that's what it is. Of course, for it to operate that way, you have to originate loans. But for us to have dollars to originate, we have to have the crowd to take us out. So it's a nice little marriage between those two pieces of the business. But in high level, that's what GroundFloor is. I know a lot of you are people that are out there that are actually purchasing and renovating these properties. I certainly can speak your language. We had a phenomenal year in 2021. We continue to expand and expect to double again in 2022. But again, all that is successful not only from the origination and the origination side of the business from people like you, but also the ones that are passively investing with those expected returns that we have. Also worth mentioning, so if there is a downside to the GroundFloor platform, it's, once the money is in, it's in until that transaction completes, right? And then at disposition is kind of when you get your expected return off that. We have created an app called Stairs. And so this is recently launched. And so this app is it's similar to Acorn. It's a high yield savings account, way more liquid than actually investing into LROs directly on the GroundFloor site. Absolutely check it out. It's a 4 to 6% return. On that, it's not bad, and that money can flow in and out of that pretty easily. You can set it up for rounding up and auto drafts and things like that. And it's something we can utilize to continue to fund originations, but it's something that allows someone who's looking to invest, still kind of in that real estate format, a more liquid way to move that money in and out, right? So, but that's the high level GroundFloor pitch. That's about all I've got for you at the moment.
Well, so I just noticed that Mr. Greenberg has actually been able to join us. Robert, are you with us? Can you hear me?
I am. Can you hear me?
Yep, we can hear you.
I'm sorry I was late. I had the usual Friday afternoon scramble, and for some reason this didn't make it on my calendar. So I missed your call, and then I was wondering what in the world. And sorry to be late. I hope I haven't missed anything too exciting.
No, we're just doing introductions. So go ahead and introduce yourself to everyone and let us know.
Nice. Yeah, this is a nice big group on a Friday afternoon. I love it.
Yeah.
I am the Chief Marketing and Technology Officer for Patch of Land. Patch of Land has been a private money lender in the space for about 10 years now. We're getting close to, well, I guess we're in our 10th anniversary year. We originally started as a crowdfunding platform. I heard, I think it was Jeff that was talking about GroundFloor. When we started, we were a similar platform. We used our loans to offer accredited investors the opportunity to recapitalize us and get access to the asset class. But as things have progressed, I'd say probably getting close to 20, 24 months since we've actually put anything onto the crowd. So we've moved on from that. So we're really just an originator. We have a full portfolio of loans. We do, of course, fix and flip, which is basically where we started, where it's most people in the business started doing fix and flip. We also do multifamily. We do ground up. We do ground up for both multifamily and single family. And we are doing a lot of long-term 30-year, the DSCR product, as well as we do mixed use. The only thing we really don't do is straight land, despite the name Patch of Land, and really no fabricated and mobile home, that kind of stuff. And then, of course, the large commercial and large multifamily, the Class A apartments and stuff like that, we don't get into. So that's the quick pitch there.
Robert, can you tell people where to find you, please?
Yeah, probably the easiest way to find this is patchofland.com.
Awesome.
And yeah,
Jeff,
pretty
I'm
much.
going to go back to you for a really quick question from the group.
Yeah.
The app again was Stairs. Is that correct?
Yeah. Stairs is the new app.
Okay. And then for all of the group, one of the big concerns for some of our members was the entrance level to be able to begin using any of the services and or products that you have. Jeff mentioned it a little bit in his overview. David, I know it's a little bit different from yours because of where you have to start with the 1031, but can you talk about the level of what that investor needs to be, and especially Jeff, the difference between what accredited and non-accredited is when we get back to you as well. But maybe start with David and go through Jeff and Robert to talk about what kind of investor would be best in using your product and where they need to be in that investing journey, or what kind of dollar level that they need to be at to be able to best use what you have available.
Sure, absolutely. So for a 1031 exchange, there really is no dollar level, and this question comes up all the time. If you assume that the 1031 exchange fees are probably going to be around $1,000, recognize that Section 1031 helps you defer or potentially avoid paying the capital gain and depreciation recapture taxes. So do a cost benefit analysis. How much tax are you going to shelter? Is it enough to offset $1,000 or a $1,500 fee? So I have clients who are selling $75,000 inner city row homes, and I have clients who are selling $75 million shopping centers and industrial parks. So it's the entire gamut. The people who don't qualify, however, are the fix and flips. Section 1031 specifically applies to properties held for use in a trade or business or for investment. So under the Internal Revenue definition, a fix and flip is property that you bought to clean up, to resell, therefore it is inventory, it is not an investment. Ideal time to get me involved, as soon as you're thinking about selling that property, so that we can explore whether a 1031 exchange is the right thing for you, whether we should refer to one of these other partners who are on the call today, whether you should change what you're doing with the property now to make it more appropriate for 1031 exchange, or whether you should simply just recognize the tax and move on.
Couple good questions there. If I am a fix and flipper and I've held it for X amount of time, and I'm going to ask you what that X is, as a rental, when can I move forward then with my 1031? How long do I have to hold for that? And then next question after that follow-up, please, is as I 1031, is there a dollar amount threshold for taking my 1031 into a DST? What does that process of not just using my 1031 into another property, but going into that DST? And I guess we probably better go back and qualify not just what is a Delaware statutory trust, but what does that mean and what can I do with it?
Sure. So when we have a property that is a rental property or a business property for that matter, maybe you're a landscaper. I did an exchange in 2021 for a gentleman who was a landscaper, and he needed to expand his business. He had too much equipment for the amount of acreage he had his equipment on. We did a 1031 exchange. So it doesn't necessarily need to be a rental property, but it can't be personal use property, the place you live in or the beach house or the ski chalet you go to on the weekend. How long must it be a rental before I can use it myself? There is no black and white answer from that. The IRS won't give us one. Candidly, I'm happy that they won't give us one, because honestly, there really shouldn't be. There are some cases where people have bought their 1031 exchange replacement property, the world changed around them, and 6 months or a year later, they moved into the property. So it's a fact-sensitive inquiry, and I'm happy to invest my time with any one of you when that issue comes up. Similarly, how long do I need to hold it as a rental before I can sell it and move on? Again, no answer. If the world changes around you, in fact, right before this call, I was on a call with a woman from South Carolina who bought a property in January of last year. And just this week, she received an offer. She wasn't even marketing the property for sale. She received an offer, one of those too good to be true, kind of stupid, silly, fantastic offers that she really has to accept. And so she's in a panic. Should she do a 1031 exchange? Can she do a 10? Yeah, she wasn't marketing the property, so it really will qualify, not a problem there. As to the Delaware statutory trusts, a Delaware statutory trust, to many people, looks an awful lot like a REIT. If you don't understand what a REIT is, you could also maybe compare it to a mutual fund of real estate. Most Delaware statutory trusts hold a portfolio of real estate. Some are single asset. The minimum investment in most of them is around $50,000. Some of them it's much larger, but you do need to be an accredited investor to get into a Delaware statutory trust.
And then what about on the reverse side? So I'm a fix and flipper. For whatever reason, I didn't flip it. I fixed it and now I'm going to need to hold it. How long do I have to hold it before it's eligible for that 1031 out of it?
That's a great question. And it comes up often when if in the event of an IRS audit, one of the things they're going to do is look at what is your business model. If your business model is to fix and flip and fix and flip and fix and flip, And then suddenly you want to do a 1031 exchange on one of those properties, even though it was truly just a fix and flip, you'll probably fail. However, if this last property is one where, for whatever reason, you didn't flip it, you exposed it to the rental market, you got a tenant in there. Again, I don't think there is a minimum period of time, so long as you treated it appropriately on your tax returns and you really did attempt to market it as a rental. Some advisors would suggest that you should rent it for a minimum of 2 years before you do a 1031 exchange. Again, I think it's a fact-intensive inquiry that I'd be happy to explore with folks. You probably won't go wrong renting it out for 2 years and then trying to do a 1031 exchange. But I also have one client who, at the last economic downturn, went out and bought a bunch of properties that were going underwater. And what he did is he went in and he cleaned them up and he turned off the water and he locked the door behind him and he just held empty houses. And in a few years, when the market softened up a little bit, he started to sell them. And he did 1031 exchanges on them. They didn't cash flow they didn't cash flow positive. He obviously had to pay insurance and taxes and electricity to keep the property safe. So it's not always black and white. And that's why having a good qualified intermediary in the conversation can be important.
And for those here that are tired of having the hammer or dealing with the tenants and toilets, you find that DSTs are good fits for many of your clients? And is there someone maybe better suited to then head into those DSTs? And that's kind of what the panel is about, is REITs and beyond, right? Like,
Yeah.
For those of us that want to put down the hammer, what does this look like?
So most of my clients who are going into DSTs fall into two categories, most of them. Some are the people who have been active real estate investors for a long time, sometimes decades. And now they're 70 or 80 years old and they just want to spend time with their grandchildren or their great-grandchildren. Others are people who inherited property from grandpa when he died, and they held on to it for a couple of years because somebody told them it was a good idea. And then they found out about the toilets and the trash and all of that other stuff, which, by the way, when this call is over, I'm actually going to one of my properties to fix a runny toilet. But I needed to go over there anyway. So those are the people who tend to go into the DSTs. Now, every once in a while, what we'll have is a transaction where clients sold a property for, I'm going to make up numbers, $500,000. And the only replacement property that they could find that they liked that met all of their other criteria was $400,000. So now they're naked on 100. They would use the DST to fill that $100,000 to avoid the taxable event. They would partner up with an advisor. They'd buy into one or two DST opportunities, and now they have protected their 1031 exchange upside.
That's a great idea. Okay, next question for you, sir, is it really only $1,000 to $1,500 to actually get your advice on heading through this 1031 process?
I saw that question in the chat and I wanted to make sure I got to it. So thank you for asking. Yes, for most exchanges, it's $1,000 to $1,500. If the transaction gets bigger or more complicated, yes, my consultations are free. They can reach out to me by phone or by email, and I don't charge for my time. If we do set up a 1031 exchange, depending on the size and the complexity of the transaction, and my clients always know the fee up front, unless something changes, right? So when we discuss it, you'll tell me what your plans are. I'll tell you this is what the fee is going to be. And I'll give you an example. I have a client who we set up a 1031 exchange. And I told her what the fee was. And then when it came time for her to buy her replacement property, she couldn't find anything that she wanted. So she found property that was going to need substantial improvements. that becomes a completely different exchange. That no longer is a simple forward exchange. That now becomes a forward improvement exchange, which requires substantially more work on my part, on my staff's work part. So I couldn't honor the initial fee structure. And I explained it to her and she understood. And the additional fee was more than offset by the tax savings of not spending all of the money.
So thank you so much.
Thank you.
Jeff, a couple questions for you, sir. Difference between what you do and a standard REIT. And then second, well, and I'll ask second question, I may have to remind you, but what happens to deals that don't raise their full funds before the end of their time frame?
Yeah, actually, I'd like to address the second one first because I will absolutely forget. So to date, there's never been a loss. There's never been a loss of the initial investment, right? So when defaults do happen, actually, and when defaults do happen, frankly, a lot of times the investors in that deal come out pretty well because obviously interest rate goes up, default interest rate is paid, and GroundFloor does not collect the interest rate that goes to the investor, right? So a lot of times you come out pretty good in default scenarios. In no case to date have we not been able to at least get the initial investment by every investor back. So right now we can say that. I hope that continues to be the case because we want to make sure that we do protect where we can there. So hopefully that answers the question. Because I know I personally have properties in default, and so far every single time I've actually come out pretty good with those. I mean, that's half of the reason why we're running at a 10% return is because some of those deals do run a higher interest rate, so it averages out to be that. And then the first question. So the difference between us and a REIT. I mean, it's one, you have full control over what properties, where you invest, who you're investing in. That is very much you, or you can spread it across the entire platform. To kind of address some of the questions that came up earlier around costs and entry points, I did touch on it, but it's worth mentioning. Anyone with $10 is an entry point. That's essentially the limit to get in, right? We have people at that rate. We have people in the 7 figures that have invested on the platform that have been there for a while. So it's all over the boards. And then there are, as far as costs to be on the front end, there are no costs. The dollars earned by GroundFloor come on the origination side of the platform, not on the investment side of the platform. So there again, it's the entry point and the ability to get in there and play around in that sandbox is pretty low.
So for those who have maybe invested in a REIT before, those being like a mutual fund, someone else is going to pick what you invest in, completely out of your control with that. With GroundFloor, you can pick the properties that you want to actually participate with.
Yeah, it's oddly enough, when I talk to the borrowers, I have a lot of borrowers that end up investing in their own property, right? So you have borrowers coming to us on the platform, they're getting charged an interest rate, but if they still have a pocket of money that they want to put toward their own investment, now they can actually earn the interest rate they're actually getting charged, right? So it's become a fun way to recapture some of the initial costs of your own transaction. And you can do that. There's no reason why you can't.
And on the platform, they can view those properties, see the stats, take a look at all of that. And then do they make their decision through the platform? Do they talk to a human to be able to be walked through that? What does that process look like, Jeff?
It depends on what you like. I mean, obviously we put a lot of energy into making sure that the platform is something that is pretty self-explanatory. But no, we definitely have a group of people that can answer those questions for you. And there is a fair amount of information that we have to provide per the SEC on these deals. So it's not like you're flying blind. There is information about the borrower that helps you guide or helps guide you through the decisions you're making on those projects. But no, there's always people you can contact. That's never a problem. I mean, we actually have some people who've been on the platform for years, and every time we put one out there, it's like we have another set of underwriters. They're going to ask questions about why we did what we did, and we welcome that.
Okay, here's a kind of specific question. Could we invest 100% of our IRA money and then have GroundFloor fund our own deal at 10% and get around the self-dealing with the IRA?
I love that thought process, and I don't know if I have a great answer to it. The first part of the answer is yes. I don't know about the second part of that question. Read that to me again. I actually want to hear that again, if you don't mind.
Could we invest 100% of our IRA money and then have ground floor fund our own deal at 10% and get around the self-dealing with the IRA?
Ugh. The loan would, forgive me, I might be butchering the answer to this. Like, the loan would have to be recourse through that IRA. It probably needs to be non-recourse. So we may run into some hurdles around that.
Yeah, I think
I love
Robert's
that.
going to jump in and give us some.
Well, Jeff, let me see if I can help. And I'm not promising you this is gonna, but I think your who owns the lien is gonna be the big issue for you. You guys are gonna need to have first lien.
Oh, of
And-
course.
yeah,
Yeah.
so-
Oh, right. Because the IRA could. Correct. Thank you.
You're
That's a much better answer. Thank you.
Well, I've been where you are for a long time.
I hope, let me know if that did not answer the question, Kim. We're trying.
It was a creative thought, though.
It was.
Hey, we're creative people. That's the
I
whole
love that,
point.
man. I mean, that's the upside. That's the upside to what we do here, right? I mean, there's not a credit box created by an institution. We have some play with that. So I always like thoughts like that. But to Robert's point, there's certainly a number of reasons why that may not play out. So.
Kim says that the biggest question was whether or not the IRA itself could invest in the in-ground floor. So that's.
I believe the answer to that is absolutely yes. Yeah.
Okay, good. That's a good start. So Robert, kind of moving on from that, we'll go back to Jeff in a second. A lot of our group has started with patch of land in the beginning, so have kind of been with you through the changes. Can you talk a little bit more about what the opportunity looks like in terms of being different now, and for our people, who's the best candidate for having a relationship with you? What does that look like with patch of land?
Yeah, absolutely. And I apologize. Scott and I are kind of trying to play catch up. And I know that how we started and the conversation that I picked up, since I joined between David and Jeff, we very much were in open platform for accredited investors coming in for as little as 5,000. And as I mentioned earlier, it's been probably 20, maybe 2 years since we've actually taken investments. So we're strictly focused on the debt side of the equation. So we definitely do business with first-time borrowers. We do loans for all types of properties, but they're always non-owner occupied. So we don't do any owner occupied business. So we're a commercial lender or business purpose lender for strictly for debt on investment property lending. And so I think that a lot of what I'm gathering from this conversation, a lot of people are looking for ways to structure investments in real estate, but not necessarily in their own deals.
Some of them are, and looking as the climate is changing, especially, I know with some of the changes that Charles was talking about coming with Freddie and Fannie on the second home deals, where people are going to be forced into maybe truing up and admitting that this is an Airbnb that they're going to do. We'll be looking for funding for that. So doing a little bit different kinds of deals and proposals as well. Is that something that Patch of Land will be able to offer as those loans draw up otherwise?
Yeah, absolutely. And like one of the things that's really interesting about what's going on in the private lending industry as a whole, not just with Patch, but certainly with us, our lowest available rate on a 30-year rental property is 3.75, which I just saw on the Today Show or one of the morning shows, that the average mortgage last year was actually higher than 3.7. I can't remember what it was. It was right around 4. And I don't know exactly how they got to that number, because traditional conventional loans have been even in the 2s a year ago, right in the midst of the whole pandemic, when it got to, I think, a historic low of all time. But for a lot of people to take a second home and do it with, where you, in an unconventional way, like on an alternative lending, our rates are super competitive. We can get the deal done easily within a month, typically within 2 or 3 weeks. And so it's, not only, and of course, we're looking at the asset, not the lender. We're an asset-based lender, as most people in the space are. So for a lot of people who wouldn't necessarily qualify for a conventional loan on a rental property, we're a super good option. And I mean, this product 4 or 5 years ago didn't even exist. When I got into the business 10 years ago, I was with one of the first companies doing portfolio loans on rental portfolios. So and that business didn't exist in 2013 when I first got into it. So it was, I mean, this is all very, very new, especially on the 30-year product. I mean, it's really blown up in the last 2 or 3 years.
And I know some of our people are looking at, again, kind of non-traditional rental things like Airbnbs or student rentals that are maybe joint rentals, not so much just standardized. Those are also things that you all can do and are interested in.
Yeah, absolutely. One of my favorites is an investment strategy that I see people doing, and particularly like the state of California has made it really lucrative from a tax standpoint, but auxiliary dwelling units, ADUs, where essentially you have a primary property and it's on a piece of property where you can, maybe there's a separate garage, and so you can add a 1-bedroom efficiency or a 2-bedroom efficiency to the top of the garage, or you can put a whole, like a cabana unit or something. And so you have somebody in the primary home that's a renter, and then you have a second renter, maybe a family in the primary home, and then a second renter, maybe a student if you're kind of near junior college or college market, or for, you know, a whole crazy range of reasons why but this works. And typically the renter doesn't ever see, one renter doesn't see the other renter. It's a driveway to the back, and there's a separate access, separate entrance, maybe even a separate garage. And so and in the state of California, really, there's some huge tax advantages to the second unit that's involved. So that's a really interesting, if you're not familiar with that, and if you already have a property, a rental property as a primary, that you could do something like that. That's a super cool idea. I've seen some really impressive numbers from that strategy.
Awesome, because I know a lot of our members are interested in Airbnbs, but we're having some challenges getting funding for that. Some people were, by the way, I know Charles said it, but just to reinforce, some people were going ahead and qualifying it as a vacation property, trying to get that loan on that. That's the end of that is coming probably at the end of this month. We are going through a process on our own, and our mortgage broker said they just got word from Freddie and Fannie that if you're not going 20% LTV in on a second home, they're going to charge you 4 points out of the gate. Yeah. So, you'd be at over $8,000 on a $200,000 property in just fees out of the gate. And they're really trying to tighten that market so that people who are going to use them as Airbnbs will start to tell the truth, and then going for the conventional rental side on that, which sometimes lenders have just not been willing to lend because they're concerned about the ongoing use of that Airbnb.
Let me just make a comment on that, because you made a really great point. And again, this is fairly new. Like in the last, I can't remember exactly what month it was. I'm going to say maybe it was August of this past year that we began. We about 50% of our business is the long-term product now, and that's a pretty hefty trend, considering 2 years ago 70% of our business was traditional fix and flip. So that's converted fairly quickly, and it's driven by a couple of major trends. One is the availability of inventory for people to flip homes has been really it's not there. So it's really hard for people to find those homes. And so a lot of people have just switched from a buy and sell strategy to a buy and hold. And also there's tons of people who either have 100% equity in their rental homes. So they're finding you can do cash out financing for homes you already own and create cash to do more investing. But for us, back to the point you were making on the Airbnb and the VRBO type property, if you have a property that you want to do a short-term rental with, we can do that. We absolutely do those loans. Your property can qualify. It hurts a little bit because if you don't have a good 12-month renter history. So if you're first time buying a rental property, even if it's been used as a short-term rental for the last couple of years, let's say it's in a great short-term rental market, you don't necessarily get the full value, because if you can't provide third-party credentials while you've owned it, third-party verification of what the monthly rent was, you take a little bit of a leverage hit. So, and when I say a little bit, sometimes you may have to have more than 20% in, but you can still finance it. It's in, and then, I think if you hold it for a year, you'll be able to refinance it if you want. But again, with the rates I'm talking about, if you can qualify, there really is not a great, and I'm certain rates are going to continue to tick up a little bit this year. We're seeing it right now, literally. I mean, I was dealing with emails today before this call where we're talking about, where are we on our rate, and, for how much longer should we even be telling people that we can do a 3.75. And, I don't think we're talking rates moving by a point or two, even that kind of thing. But I think we're looking at rates are going to move a quarter relatively soon. If not, it maybe has already happened. And it's probably going to move another quarter. And so this summer, it's probably going to be more like 4.5 or 5 for these long-term properties. And I see Jeff kind of nodding. I mean, and David laughing. And so I think everybody probably is fairly aware that the rates are moving.
Awesome. Thank you. Jeff, I'm getting a couple of interesting comments here. Is there an age limit for who can invest? Do you have to be 21? People are saying at $10, if that's the investment, they'd love to introduce their kids to investing. What does that look like in terms of where's that threshold?
I would love to get back with you on that. I don't know if I have it. I would hate to answer that incorrectly. And that is not a question that's been asked. And I think that's an exciting thought. So if I could, I would get back with you on that. If that's, can I share that back with you, Rebecca, and get it back to the group? Because I'd
love to, and we can distribute that.
Yeah, that is very interesting.
Yeah, let me throw out, and you just tell me if you think I'm off track on this. Yeah. I think clearly the definition of accredited investor today doesn't have an age limit. So it's really, do you have the money in the bank, or do you have a W-2 income that shows that you make $1 million? I mean, that's their criteria is going to be, or can you prove you're an accredited investor?
Yeah, and we work. Yeah, so we work with non-accredited investors. So I would make the assumption that that's okay. I just want to make sure that because it's non-accredited, there was some other weird stipulation that I'm just not aware of, and I don't want to misspeak about that. But I think Dave, I think Robert is most likely correct, but I just want to double check. That is new.
Let us know. We may need to
awesome.
come back on that topic, because I think a lot of people will be really excited to work on that with their children.
That's a cool thought. That's a really cool thought. But I will absolutely ask, and by the end of the day, have a response for you for sure.
And can we go back? Oh, I know we kind of touched on it, but can you, again, the difference between an accredited and a non-accredited, and why your platform has such an advantage? Because our people have a lot of money tied up. They've got it, but it is certainly not liquid enough to get them over that threshold sometimes.
Yeah, no, it's so we have the appropriate licensing requirements in place to allow non-accredited investors. So there is no net worth requirement or minimum amount, that is needed, that has to be confirmed to invest.
Does anybody remember what the accredited threshold is? I used to know.
It's 250,000, I think.
And that has to be liquid, yes?
$250,000 a year in W-2 reportable income, or $1 million of net worth in your bank.
And does anybody, is that per individual, or is that
yeah, I think if you're married, it's $1.5 million. It's been a while since I've seen these numbers, Jeff, and I think it's 300,000 for combined income.
It's funny, that sounds right. It's something I don't look at a lot. So if it has changed, I'm not aware of it, because since we work with non-accredited, it's something I don't focus too much in on. But that sounds right.
I'm just trying to show what an advantage it is to be able to invest as a non-accredited, because so many of our people, like I said, have a challenge with those thresholds, because so much of them, is coming through the properties.
Yeah. The income level is 200/300, 200 as an individual, 300 with your spouse. The net worth is $1 million for the marital union.
Got it. Yeah, so that looks like Lori just shared something as well. Thank you.
Awesome. The other thing, Jeff, that the group is curious about one of the biggest barriers to getting people to stay in a REIA group is they become concerned about doing their first deal. So spending the first check, right? Writing the first check, doing whatever the first thing is to invest in real estate tends to be the scariest. So would this be something that would be interesting maybe at our REIA groups to allow this to be the entrance that they need into the investing world? Is that something that would make sense for them to promote at their groups, especially at some of these lower investment levels?
Yeah, absolutely. I mean, yeah, paralysis by analysis, right? And that's one of the beautiful things about just investing on the platform. Aside from not having the know-how to go out and swing a hammer, or having the connections to actually put together a relationship with a contractor you trust and get the thing done, and then having the monetary backing to bring the 10, 20%, whatever it is to start, that's not needed. If you have a few $1,000s, if you have $40, you can put that to work in a real estate world. And so, it's pretty easy to use. It's not meant to be difficult. And so, and especially, it's just another way to steward your own investments and invest in something, tangible. And I think it's enjoyable, to be honest. I've always liked that model. It's nice to know the money that I'm lending is coming from people like me, right? So when you're assessing risk, it's a whole different mentality when you're not thinking about institutional and insurance companies' money. You're thinking about, I have to think about my money. I think that's going into that transaction. I like that.
And do you have a sense of who might be the best fit for this? Is it somebody who's diversifying, somebody who's getting started, people who are getting out of the fix and flip or rental business and want to put their money somewhere else?
I think those are all great reasons. Our platform was full of all things considered that you just said. There are a lot of people, it's almost like retiring. They've retired from the purchase and rehab world and has figured out another way to make their money work for them in real estate. A lot of our platforms made up of that. I would say a majority of the people on our platform are probably still classified accredited investors. I don't know if there's a reason why that is. I'd have to really dig into that. But I think the goal was to create something. I mean, the whole premise of the company was to create something where that type of wealth wasn't needed to play in real estate. It'd be great to find some way to actually create wealth in real estate, right? Instead of having it in order to get into real estate. So that was kind of the goal.
Awesome. 2 other quick questions. Where are most of your deals sourced from?
As far as the dollars from the crowd, every dollar.
I think they are asking about the property that is being put onto the platform.
As far as geographic location?
Yes.
Yeah, so we're in 35 states. Majority of it's going to be up and down the Eastern Seaboard through the Midwest. We actually just opened up California in the last 3 or 4 months. That's still relatively new to us. A lot of our investors are in California, and we obviously decided, well, that would be stupid not to continue to play in California. But most of what we do is up and down Eastern Seaboard.
And there's no restriction in terms of where someone's from to invest on the platform?
I don't believe so. Yeah.
Okay. Another sort of technical question. Is it possible to roll over a 457 plan into the fund?
I have no idea. I will get that answer for you. Of course,
Sorry about all these technical questions.
I love it. No, it just shows you, it shows that I'm the head of originations, right? It's not the investor side. So I will write that down now, and I will get an answer for you. It's a solid question. At 457?
Yes, please.
I love it.
Jeff, I can't give you any help on that one either.
Oh my gosh, I was waiting for you. I'm like, man, surely Robert knows. I will plan roll over. I will find out. And age limit. Okay. What else we got?
I think those are all the really specific questions I think we've kind of covered in our discussion. Other things, we're getting close to our time to sign off. Thank you so much for being here, but any parting suggestions for where we are in the new world that we're operating in, and what your platforms can bring to us and help us with as we leverage our business forward and try to accommodate all of the new changes that we're seeing? Anyone can jump in there, either Jeff or Robert, please.
You know, whether it's from an investment side of the platform, I mean, whether it's short-term savings account, you know, high yield savings account type stuff, absolutely check out Stairs. It's liquid, it's easy to move money in and out of. It's something you can turn on and forget about. But if you know, long-term investment, 10 to 12% returns, you know, the GroundFloor platform is a fun one to play in. You know, so I highly recommend, as you're looking for diversification as we go into, you know, what feels like always an unknown world. It held really well through COVID. I feel like I haven't lost $1 on it yet. I'd love for that platform to double so I can continue to double my originations, right? So the more the merrier there. And the more of you on there, the more property on there, the more diversified the entire risk that gets. So
I'll just throw out the one thing. I think the space that we're in real estate the outlook is still really, really good. The housing stock in America is obviously under pressure. With the new builds are not nearly where they need to be. I think we went a whole decade running at about 50% of where we should have been. So I think we're investing in real estate, and you know, even where prices are in some of these outrageously, you know, 17, 20, and even 25% year-over-year growth in home price values. I think that certainly there's some markets that are going to cool, and maybe some that are showing evidence of going down a tiny bit, but by and large, I think prices are going to continue to go up. Hopefully they won't continue to go up at the rates we've seen in the last 2 or 3 years for sure. I don't think that's necessarily great for anybody other than the people that are holding a lot of property and trying to get out of it. But I think, you know, we're in a great space, and I think, you know, just look for good opportunities and, you know, put your money to work.
Awesome. Robert, if you could put your contact information, like people to reach out to you, or the patch of land information in the chat bar, so people can follow up and take advantage of the opportunities that you all have. We'll definitely be checking in with you again further in the year, especially to get back with the questions that people have, that we can follow up back with them. Thank you so much for being with us today. We really appreciate it. It sort of also gives a great insight into where we're going with the rest of our alternative investing series. Like I said, next month will be our industry update with John Burns Consulting. We have Day on the Hill virtually in March. We then come back with some additional platforms to use to help you in your investing in April. And then in May, we'll finish this series up with a panel right in time for our leadership session in June for mid-year. So thank you so much for being with us. We really appreciate you. Ryan, I'm going to turn it back to you to sign off. Please remember that the contact information for the panelists are over in your chat bar. Feel free to reach out to them. You'll also get a replay for those of you that signed up in your own name with your own email for this session.
So thank you, Rebecca. Also, thank you to Charles for the update today. Thank you to our panelists, Robert, Jeff, and David as well. Thank all of you guys for coming here and showing up today. We had a great turnout. Make sure you mark your calendars. Our next events for the quarterly leadership call is February the 16th. And then the REIA Zoom call is going to be February the 18th. So we'll see you guys here on February the 18th and also February the 16th. So thank you guys for joining. We'll see you next time.
Thank you.